Ladies and gentlemen, good day and welcome to AXISBANK conference call to discuss the Q2FY23 financial results for the quarter ending as on 30th September 2022. Participation in the conference call is by invitation only. AXISBANK reserves the right to block access to any person to whom an invitation has not been sent. Unauthorized dissemination of the contents or the proceeding of the call is strictly prohibited, and prior explicit permission and written approval of AXISBANK is imperative. As a reminder, all participant lines will be in listen-only mode. There will be an opportunity for you to ask questions at the end of briefing session. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. On behalf of AXISBANK, I once again welcome all the participants to the conference call. On the call we have Mr. Amitabh Chaudhry, MD and CEO, and Mr. Puneet Sharma, CFO. I now hand the conference over to Mr. Amitabh Chaudhry, MD and CEO. Thank you, and over to you, sir.
Thank you, Stephen. Good evening and welcome everyone. Apart from me and Puneet, we have on the call Rajiv Anand, Deputy MD, Amit Talgeri, Chief Risk Officer, and members of the bank's leadership team, Subrat Mohanty, Ravi Narayanan, Sumit Bali, Munish, and Sanjeev Moge. The growth momentum in India continues to hold up well at a time when majority of the world is staring at a slowdown. This is reflected in several macro indicators. The system credit growth and domestic consumption remain strong. We at Axis Bank remain optimistic on the growth opportunities in the Indian economy and our ability to support and take advantage of them. In this quarter, we continued the strong performance in our identified strategic segments. We saw continued momentum in granularization and premiumization of deposits, market share gains in Bharat and SME segments, industry-leading performance in cards, further strengthening of our transaction banking franchise, and acceleration on digital banking outcomes. A quick aside on digital banking. Today, we are the highest-rated mobile banking app in the world. We are extremely proud of it. I will speak about it later in this discussion. Coming back to the quarter, we stayed on course on 3 core areas of execution of our GPS strategy, which was around deepening a performance-driven culture, strengthening the core, and building for the future. Let me now discuss each one of these in further detail. On performance-driven culture, we continue to show and deliver improving profitability metrics. Our consolidated annualized ROE for Q2 financial year 23 stood at 18.9% and has consistently exceeded 15% in the last few quarters. While Puneet will provide granular details, let me highlight the trends across key operating metrics. Our core operating performance in the current quarter is strong on all parameters, both year-on-year and sequentially. Net interest margins improved 57 basis points year-on-year and 36 basis points quarter-on-quarter to 3.96 in the second quarter of this financial year. Fee growth of 20% year-on-year and 8% quarter-on-quarter, with retail fees up 28% year-on-year and 10% quarter-on-quarter. Core operating profit grew by 43% year-on-year and 19% quarter-on-quarter. OPEX growth moderated to 14% year-on-year and almost flat sequentially. PAT at rupees 53.3 billion was up 70% year-on-year and 29% quarter-on-quarter. The bank's ROA has significantly improved from 0.66% in financial year 19 to 1.66% in the half year annualized, and consolidated ROE is up from 8.58 to 17.25 during the same period. Our ROE is up 545 basis points year-on-year. We lifted the growth trajectory and consistently gained market share. We now have strong market position in multiple businesses. On advances, we continue to grow faster than the industry with incremental market share of 7% in last 3 years and closing market share at 5.7% as of September 22. On deposits, we have gained over 69 basis points market share in 3 years to reach 4.7% as of September 22. In credit cards, we continue to be ranked 4th largest with over 13% incremental spends market share in the last 9 months against 11.4% period-ending market share for cards in force. On the payment side, we continue to have strong positioning with 16% market share in UPI and 15% in mobile banking. Our Burgundy AUM has grown by 3x CAGR in over the last 5 years, and today we are the 4th largest player in wealth management business. Similarly, on the wholesale side, we continue to have strong market share in transaction-oriented flow businesses with 12% market share in foreign LCs, 9% in NFT payments, and 8% in RTGS. We've also been the leading player in the DCM space over the last decade. The strong growth in our granular deposits continues, with average CASA balances up 13% year-on-year. Our liability strategy driven through premiumization, granularization and deepening remains on track, reflected in 220 basis points year-on-year improvement in share of premium segment in existing to bank retail savings deposits. From an LCR perspective also, we continue to see improvement in the quality of our deposit franchise. Early improvement in the quality of granular liability growth is visible through reduction in outflow rates. The steps we have taken towards improving the quality of liability franchise have definitely started yielding results. However, this is the beginning of an improvement journey that will only gain traction over time. We are the fastest growing card acquisition franchise. We issued over 1 million cards this quarter, up 88% year-on-year. Our credit card spends were up 70% year-on-year and 17% quarter-on-quarter, and card advances were up 47% year-on-year. Our known to the bank strategy continues to progress well, with 31% of our cards sourced through partnerships. During the quarter, we launched a co-branded credit card in partnership with Samsung India that will help us to further increase card penetration in Tier 2 and Tier 3 cities. In Quarter 2, we continue to witness strong momentum across our focus retail and SME business segments that grew 22% year-on-year and 28% year-on-year respectively. The strength of our wholesale franchise is demonstrated through 9% year-on-year and 7% quarter-on-quarter growth in our domestic corporate loan book. We have achieved this while simultaneously improving our margins. MSME segment continues to remain a key growth driver for the bank. Our mid-corporate book grew 49% year-on-year and 9% quarter-on-quarter. Our SBB segment delivered strong growth of 69% year-on-year. The combined portfolio of the three segments, small business banking, SME and mid-corporate, grew 41% year-on-year and now constitutes 22% of the loan book, up 542 basis points in last 8 quarters. Our government business performance remains strong as we continue to add new mandates and gain market share. This business has transitioned from being deposit-centric to more solution-centric. We continue to win single nodal accounts and stand among the top performers in private bank space in the central nodal account opportunities, both of which have helped us to drive growth in government deposits. Around fostering a winning mindset, our winning mindset is reflected in our strong business performance and multiple external recognitions we received during the quarter across digital, fintech innovation and other businesses. The bank's Axis mobile app ratings on the Play Store have gone up from 4.6 to 4.8 now. As I said earlier, we are now rated as the world's highest rated mobile banking app on the Play Store with over 15 lakh reviews, which is the highest across 59 global banks, 8 global neobanks and 50 Indian fintech apps. The Axis mobile app has over 10 million monthly active users, close to 52% savings account and 43% CA customer registrations and 4 million plus loan account registrations. The app now handles over 64% of all service requests by volumes and doubles up as our largest branch. The bank, in partnership with CRM Next, won the Best CRM Implementation at the Asian Bank of Financial Technology Innovation Awards 2022. We also won the Data Engineering Excellence Award at Cypher 2022, hosted by Analytics India magazine. The award recognized the bank for excellent use in producing outcomes at a large scale with respect to our personalization project. During the quarter, the bank won 2022 Greenwich Excellence Awards for India large corporate banking and middle market banking segments for the second consecutive year. The bank was recognized for its distinct qualities like ease of doing business, knowledge of transaction banking needs, coordination of product specialists, and customer service. The bank Dubai International Financial Center branch also won Customer Service Excellence Award in the banking category at the recently held Middle East Indian International Business Awards. The bank's Bharat Banking segment also won the Best Digital Financial Inclusion Initiative at the ET Digital Lending Transformational Global Summit. As far as strengthening the core is concerned, our strong balance sheet lends support to drive our aspirations. Our asset quality is now among the best in class with net NPA of 0.51%, high provision coverage of 80% and standard asset coverage of 1.6%. Our internal accruals are becoming largely sufficient to fund the business growth in Quarter 1 and Quarter 2. Our CET1 stood at 15.14% compared to 15.24% in March 2022. We continue to build our next generation technology architecture. We have modernized the core and strengthened technology capabilities significantly in the last few years to undertake transformational digital banking projects Project Neo is all about building a world-class digital corporate bank. Leadership on APIs is the cornerstone to win new clients and new transaction banking businesses from existing clients. Corporates are strategically pivoting towards APIs, and we have built a strong product market fit here via best-in-class developer portal, build an industry best-wide array of APIs spanning all transaction banking products, and delivering integrated banking experience through partnerships. We are witnessing a strong momentum in customer adoption and are partnering with our customers to offer the optimal solution based on digital maturity. We have become one of the first in the industry to launch a suite of trade APIs for corporates, with first customers going live successfully. Our digital onboarding through API developer portal and ERP agnostic plugin enables seamless onboarding and integration for customers. We are seeing over 10x growth in transaction volumes and 2x growth in adoption. We expect the momentum to sustain over the coming quarters as we further expand our capabilities and partnerships. What is extremely heartening is that the adoption has been amongst the leading corporates in the country and across industries, from financial institutions, government clients to large conglomerates. Building for the future, we have created distinctiveness in digital and are today a class apart. Our digital banking unit Open is now operating at scale. The impact of this is visible across various business segments. In line with our Open philosophy, we launched account aggregator-based loans and credit cards this quarter. We now have built the full stack for end-to-end digital lending and cards for both existing and new customers. Now, any citizen of India, our customer otherwise, can come to any of our digital channels and get instant digital paperless loans on credit cards. We are the first, or credit cards. We were the first bank to go live on the account aggregator framework, and we are the first to launch this capability. We are seeing good initial traction. Our disbursal volumes have grown 30% month on month since launch. This quarter, we launched a significant upgrade to our mobile app as part of our Channels 2 program. We have crossed multiple milestones and will be launching few more significant changes to our app going ahead. We have upgraded our developer portal and now made digital and self-serve the entire setup and UAT process. We believe we are now best in class in the country on this front. Our bank-wide programs to build distinctiveness, a quick update on that. Bharat Banking strategy continues to scale up well. Our distinctiveness initiative around Bharat Banking continues to deliver strong outcomes. Rural and semi-urban markets are an important growth area for us, and we see significant opportunity to gain market share in these regions while driving higher profitability. During the quarter, we added 1,600 village-level entrepreneurs to take our overall CSC Valley network to 54,000 plus that would act as extended arms for our 2,065 Bharat branches. As a result of our focused approach, we achieved strong 28% year-on-year growth in disbursements across all the major product segments and delivered 46% year-on-year growth in rural loan book. Our subsidiaries continue to create significant value. The One Axis approach, now embodied across Axis Group, is reflected in robust performance of our subsidiaries. The total annualized PAT of our domestic subsidiaries in first half was up 14% year-on-year. A quick update on Citibank consumer business integration. The CCI approval is in place. We expect to complete the transaction by end of fourth quarter of fiscal 2023, which is the legal closure date. At present, the Integration Management Office with a steering committee is in place that's working across 17 key work streams around people, technology, and business operations. The progress on customer communications, design of end-state operating model, day one business and operations readiness, and the performance of existing Citibank consumer business is trending in line with our expectations. In closing, the global geopolitical and macro environment remains uncertain, which has prompted significant downward revisions by multilateral institutions of their growth and trade forecasts. In the domestic context too, there are a few challenges. Inflation has remained above 6%, current account deficit is expected to be high, and deposit accretion in the system has been slower than credit growth. The monetary and fiscal policy responses in India have been agile while balancing the policy challenges towards the least growth sacrifice outcomes. These moves and our engagement with our customers gives us strong reasons to remain optimistic. I will take a moment to step back on how we have fared since the end of pandemic almost a year back. In the last 4 quarters, we have shifted our performance trajectory upwards meaningfully. We are clocking 15 plus ROE consistently. Our operating margins and NIM are in the zone of best performing franchises. We see acceleration in our focus segments, and there is an all-round improvement in all key performance metrics on deposits and assets. We are leading the way on digital technology modernization and innovation. We believe as a group we are playing to our potential as we continue to build a strong, future-ready and open franchise. I will now hand it over to Puneet for further comments.
Thank you, Amitabh. Good evening and thank you for joining us this evening. We continue to make meaningful progress on strengthening our core business performance and ensuring that our balance sheet is resilient across cycles. I will discuss the salient features of the financial performance of the bank for Q2FY23, focusing on our operating performance, capital and liquidity position, growth across our deposits franchise and loan book, asset quality, restructuring and provision. Our operating performance in the current quarter is strong on all parameters, both YOY and sequentially. We have improved net interest margin significantly, delivered robust growth in net interest income, growth in granular fees, and controlled our operating expenses. The resultant strong core operating profit growth coupled with benign credit costs resulted in a significant improvement in our ROA and ROEs. Net interest income for Q2 FY23 stood at 10,360 crores, growing 31% YOY, 10% Q1Q. NIMs for Q2 FY23 stood at 3.96%, growing 57 basis points YOY and 36 basis points Q1Q. Domestic NIMs crossed 4% during the quarter. We had clearly articulated the drivers of our NIM improvement journey. The progress against each of the key drivers in the quarter is as follows. Improvement in the balance sheet mix to loans and investments from other assets. Loans and investments comprised 86% of total assets as at September 22 compared to 83% as at September 21. Within advances, INR denominated loans comprised 93% of total advances as at September 22 as compared to 89% at September 21. Within advances, the retail and CBD segment comprised 69% of total advances at September 22 as compared to 65% as at September 21. Low-yielding RIDF bonds declined by 8,329 crores YOY and 4,612 crores sequentially. RIDF comprised 3.09% of our total assets as of September 2022 compared to 4.28% as of September 21. The bank continues to improve its risk-return profile on its loan book. Our net interest income as a percentage to average risk-weighted interest-earning assets stands at 7.75%, improving 80 basis points YOY and 49 basis points Q1Q. Our fee income stood at 3,862 crores, growing 20% YOY and 8% Q1Q. 93% of our fee is granular. Total retail fee grew 28% YOY and 10% Q1Q. Digital and mobile banking fee grew 45% YOY. Fees on retail cards and payments grew 53% YOY and 16% Q1Q. Fees from third-party distribution grew 20% quarter-on-quarter. Transaction banking, including commercial card fees, grew 30% YOY and 11% quarter-on-quarter. Trading losses for the quarter stood at 86 crores compared to a loss of 667 crores in the previous quarter and a profit of 473 crores for the same quarter last year. The MTM is largely on our corporate bond book, 80% of which is AA plus and above, and 96% is rated A minus and above. We do not expect an economic loss on this book. All else being equal, the pull to par period for this book is 4 to 5 years. Operating expenses for the quarter stood at 6,585 crores, growing 14% YOY and flat sequentially. The YOY increase in rupee crore expenses can be attributed to the following reasons. 9% is linked to volume growth, 51% to technology and growth related investments by the bank, 1% on statutory costs, and the balance for BAU linked growth. Technology and digital spends grew 19% YOY and constituted 8% of our total operating expenses. Staff costs increased 12% YOY and declined 1% quarter on quarter. We've added over 2,015 people from the same period last year, mainly to our growth businesses and technology teams. We have continued to maintain the social security provisions. The cumulative social security provision for the bank stands at 227 crores. Cost to income ratio for Q2 FY23 at 46% improved 328 basis points YOY and 641 basis points Q1Q. Operating expenses to average assets stood at 2.25% for Q2 FY23, higher by 13 basis points YOY and 1 basis point sequentially. Given the strong momentum across all our businesses, we remain committed to consciously invest in our focus business segments. The lower credit cost over the past few quarters has provided us headroom to run operating costs at a slightly elevated level. We remain committed to achieving the around 2% cost to assets in the medium term. Operating profit for Q2FY23 was 7,716 crores, increasing 30% YOY and 31% Q-on-Q. Core operating profit stood at 7,802 crores, growing 43% YOY and 19% Q-on-Q. Provisions and contingencies for the quarter were 550 crores, declining 68% YOY. The bank has not utilized any of its COVID-19 provisions. This provision is entirely prudent. Annualized credit cost for Q2 FY23 is 0.38%, declining 16 basis points YOY. Profit after tax stood at 5,330 crores, growing 70% YOY, 29% quarter on quarter. Consolidated ROE stood at 1.87%, improving by 59 basis points YOY and 39 basis points Q on Q. Subsidiaries contributed 7 basis points to the ROA for this quarter. Consolidated ROE for Q2 FY23 annualized stood at 18.90%, improving by 545 basis points YOY and 334 basis points Q1Q. Subsidiaries contributed 41 basis points to the consolidated ROE this quarter. The cumulative non-NPA provisions as of September 30th, 2022 stand at 11,625 crores, comprising COVID-19 related provisions of 5,012 crores, restructuring provisions of 1,100 crores. Unsecured retail restructured loans have been provided at 100%, and the rest are provided at first bucket NPA rates. Standard asset provisions at higher than regulatory rates of 4,332 crores, and weak assets and other provisions of 1,181 crores. Our provision cover, all provisions, NPA plus non-NPA divided by GNPA stands at 138.35%, improving 1,454 basis points YOY and 484 basis points Q1Q. Our capital adequacy ratio, including profits for the half year ended 30th September, is 17.72%. Our CET1 ratio stands at 15.14%. The prudent COVID provisions translate to a capital cushion of 55 basis points over and above the reported capital adequacy. Our LCR ratio for the quarter was 121%, improving sequentially. Our excess SLR stands at 55,513 crores. The risk-weighted assets of the bank as at 30th September 2022 stand at 66%. Growth across our liability and loan franchise. Amitabh has discussed the progress on customer acquisitions, growth in liability and loan franchise in his opening remarks. Please refer slides 18 and 19 for details around the quality of our liability franchise and detailed slides on our loan franchise in our investor presentation. Our CASA ratio on an MEB basis was 46%, improving 172 basis points YOY and 251 basis points Q1Q. Our loan book gross of IBPC sold grew 19% YOY and 5% Q1Q. Our loan book continues to get more granular and balanced, with retail advances constituting 58% of overall advances, corporate loans at 31% and CBG at 11%. 68% of our loans are floating rates, which positions us well in the rising interest rate environment. 45% of our fixed rate book matures in 12 months. Breakup of the floating rate loan book by benchmark type and MCLR repricing frequency is set out on slide 11 of our investor presentation. Retail advances grew 22% YOY and 3% sequentially. Unsecured disbursements for the quarter constituted 24% of the total disbursements in the quarter. Q2 FY23 retail disbursements for our small business banking, rural and PL book were up 33%, 28% and 26% YOY respectively. Cards and PL portfolio grew 47% and 22% YOY respectively. The retail loan book now represents healthy characteristics, with 89% being secured. The credit card spends for Q2 FY23 grew 70% YOY. Industry spends growth is being driven by a pickup in commercial card spends. We have consciously focused on growing the profitable retail card segment. We are progressing well on our endeavor to build a profitable and sustainable corporate bank. Details of rating composition, incremental sanction quality are set out on slide 35. of our presentation. Corporate loan book including IBPC grew 7% YOY and 6% quarter on quarter. Offshore wholesale advances are largely trade finance related and primarily driven by our GIFT City branch. 97% of the overseas standard corporate loan book in GIFT City is India-linked exposures and 95% is rated A and above. The commercial banking book grew 28% YOY and 7% sequentially. The quality of the CBG franchise we are building and the strong relationship-led approach is reflected through our CBG card deposits on a quarterly average balance basis growing by 31%. Overall fees from the CBG business growing 14% Q1Q and 87% of our CBG loan books being PSL compliant. Coming to the performance of our subsidiaries, detailed performance of our subsidiaries are set out on slide 60 to 66 of our investor presentation. Domestic subsidiaries reported a total net profit for H1 FY23 of 585 crores, up 14% YOY. This translates into a return on investment of 46% and contributes 7 basis points to consolidated ROA and 41 basis points to consolidated ROE. Axis Finance delivered strong growth as a full-service customer-focused franchise, offering retail as well as wholesale lending solutions. In Q2 FY23, overall AUM grew 53% YOY and 8% quarter on quarter. Retail book grew over 2.6 times and now constitutes 39% of the total loans, up from 8% 2 years prior. Axis Finance's book quality continues to be strong with net NPA at 0.42%, negligible restructuring and stage 3 at 0.10%. Axis Finance H1 FY23 PAT grew 53% to 210 crores with an ROE of 16.6% and a CAR of 19.6%. Axis AMC average AUM grew 4% YOY in Q2 and the equity AUM was up 8% YOY. Investor folios grew 34% YOY during the quarter to take the total investor base to 13.2 million. In H1 FY23, PAT grew 24% YOY to 183 crores. Axis Capital reported a H1 FY23 PAT of 64 crores. Axis Securities continues to see strong traction. New client additions in H1 FY23 stood at 0.38 million, up 97% YOY. The broking revenues for Axis Securities grew 9% in H1 FY23 and PAT for H1 FY23 stood at 100 crores. Asset quality, provisioning and restructuring. Annualized gross net slippage ratio for the quarter improved YOY and Q1Q. The slippage, GNPA, NNPA and PCR ratios for the bank and segmentally for retail, SME and corporate are provided on slide 52 of our presentation. GNPA was 2.50%, improved 103 basis points YOY and 26 basis points Q1Q. NPA was 0.5%, declining 57 basis points YOY and 13 basis points Q1Q. PCR at 80% improved 974 basis points YOY to 165 basis points Q1Q. We have not sold any non-performing loans in the quarter. The recoveries from written off accounts for the quarter was 709 crores, improving 32% YOY. Net slippages for the quarter adjusted for recoveries from written off pool was negative 152 crores. Reported net NPA slippage for the quarter is 557 crores, declining by 21% YOY. Gross slippages for the quarter were 3,383 crores, lower by 38% YOY and 8% sequentially. For the quarter, 39% of the gross slippages are attributable to linked accounts for borrowers which were standard when classified or have been upgraded in the same quarter. The BB and below book of the bank declined 26% YOY and 2% sequentially. COVID restructuring stands at 0.38% of gross customer assets. More details on the BB and below book and restructuring are set out on slide 56 of the investor presentation. To summarize, consistent delivery of 15% plus ROE over the last 3 quarters, improving quality of earnings, and with profits in H1 FY23 being sufficient to fund growth, we are demonstrating delivery across all the initiatives undertaken by the bank. Our CASA ratio at 46% on an MEB basis as at 30th September, and early improvement in the quality of the granular liability growth visible through reduction in outflow rates gives us comfort that we have laid a strong foundation for our liabilities journey. Our assessment is that improvements planned over the next 8 to 10 quarters are on track, with some inter-quarter fluctuations which are normal for a business of our scale and size. Focus growth segments like retail, SME and mid-corporate with better ROCs continue to grow faster at 22%, 28% and 49% respectively. Our balance sheet resilience is visible through the strong capital adequacy and return ratios for the quarter. Overall coverage at 138.35% of GNPA and limited COVID restructuring of 0.38% places us in a good position in the current macro environment. We continue to closely monitor geopolitical, inflation, both domestic and international liquidity risk and its impact on cost of funds, resultant policy action by all organizations and impact on our business and our client businesses as we move forward. We would be glad to take your questions now. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. An operator will take your name and announce your turn in the question queue. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mahrukh Adajania from Nuvama. Please go ahead.
Congratulations. My first question is on margins. So congratulations on an excellent margin achievement. But how do you look at margins going ahead in the next, say, 2 to 3 quarters? Because there's still repricing left. A part of the MCLR repricing, apart from the EBLR book, MCLR repricing is also yet to come in. So how do you view margins in the next few quarters?
So, very different. We don't give guidance on margin, but let me make a couple of comments here. One is that, we have always talked about the fact that whatever we are trying to do in Axis Bank is to build a sustainable franchise and sustainable, a P&L. So the idea behind delivering a margin of this kind is to be able to sustain it in a particular zone. We have always been guiding that our first target is 3.8% and obviously keep it there. We have now reached 3.96%, and obviously all of us will try very hard to ensure that we remain in the same zone. There are a couple of things which are at play here. One is on one side, as you rightly pointed out, some deposits will get repriced. The overall interest rates might continue to rise, and so there is a potential in the future that our cost of deposits will rise faster than what we have seen till now. Secondly, on the flip side, yes, the impact of increase in some of the MCLR rates which you have talked about will continue to come through. We will also hopefully see higher yield in some of our asset classes, and that will also take time to kind of feed into our system. We have talked about the fact that we've been meeting the PSL requirements and our RIDF bonds are coming down, but that is again not played through in our NIMs because the impact on the spreads has been lower because what is maturing was at a decent rate. What is not matured is at a low rate. So the fact that whatever we have done on the PSL side, the impact of that in NIM has not come through as yet. So there are various factors at play. Obviously, the Axis will continue to try to ensure that, as I said, be in the zone. We will also like to ensure that we use this opportunity to invest back in the business as much as we can. So I'm not giving you guidance, but I'm giving you hopefully enough fodder to think through as to where we could potentially end up.
Sure, thanks. And just in terms of retail deposit growth, so you have given some numbers and talked about granularization and premiumization. But if you could give the like-to-like retail deposit growth or any quarter-on-quarter retail deposit mobilization growth so that we know the like-to-like number, because currently it's being masked by the conversion, right? So I'll give you some data points, not exactly maybe what you want. Our growth in CASA was 14% year on year related to industry, which is at 10% year on year. So it continues to be higher and faster than our market share growth in total deposits, where it was 10% for Axis versus 9% industry. So first point is CASA is growing faster. Second, we continue to focus at district level market share gains. The number of districts where our market share is greater than 5% has improved by nearly 35% since March 2020. Overall TD growth was restricted due to lower CD issuances. Our premium segment, where you asked a question, premium segment savings deposits are growing at a faster pace, 18% year on year versus 14% for overall
savings accounts, resulting in share of premium segment deposits going up by 220 basis points year on year. We saw 64% year-on-year growth in new corporate salary levels in first half of financial 23. And last, an important point, with increased focus on LCR accretive deposits in financial 23, we have seen a 550 basis points improvement we have attained in weighted runoff of our TDs. So the focus is across every part of our franchise, and I'll give you some data points which will kind of prove you that.
Thanks. And just one last question on OPEX. So now it's remained flat for the last 3 quarters. Of course, Puneet did mention maintaining the medium-term guidance, but it's actually remained flat. So how do we look at it going ahead?
So Maruk, thanks for the question, Puneet here. The rupee crore number you've observed has been flat. I think our guidance is on cost to assets, and we do continue to maintain that medium-term 2%, around 2% is achievable, and we stay committed to that number. And it'll have multiple factors. We have structural cost savings, we have growth, both of which will drive us to achieve that number. And I think we're not offering shorter-term guidance on cost numbers as on date.
And let me just add to what Puneet said. On the cost side, we have invested over the last couple of years. We also want to ensure that, as you make the investments, initially you incur costs up front, but then you start getting productivity benefits to come through. So you might see it as a constant cost for a couple of quarters, but I think the way you should look at it is that the investments which are made, now we are seeing the productivity benefits come through, and so while the costs remain the same, you are seeing a lift on the revenue side. So, we'll obviously continue to, as we see the productivity benefits come in, and we see the growth come in, we'll make some more investments in costs, and hopefully now, rather than again going through a cycle like that, it will flow, together. So the correlation will be sharper than what you've seen in the past.
Sure. Thank you so much, and congratulations once again. Thanks.
Thank you.
Thank you. The next question is from the line of Adarsh Parasrampuria from CLSA. Please go ahead. Mr. Parasrampuria, sorry to interrupt, but you are not clearly audible, sir. May we request you to move to handset mode, please?
Okay. So congrats, Amitabh, Puneet and team. Question is on the margins, right? You did give a lot of details around the improvement in the mix in terms of investments, INR loans, retail, within that unsecured, and then RIDF. And we obviously had a very large margin improvement. Part of it would be related to where the rate cycle is. Would it be possible for you to just indicate what kind of improvement in spreads could have been a little more structural from the mix side? That will be really helpful for me if you can try and give some broad numbers there. Hello?
Adarsh, thanks for the question. Adarsh, like we said, the NIM journey had 2 variables, assets plus liabilities. I think we're structurally on the right path of our NIM journey, and we've reported to you the sequential improvement on each of the parameters across assets and the quality of our liabilities. I think that's where we will leave it at the moment. It's very difficult to call out what is rate effect and what is structural effect at the moment. I think we are a running business, so I think we'll leave our response at that. All we'd say is all of our improvements are fundamental and structural, and therefore retention of the improvements will stay within the business.
Got it. Hello?
So you have any other questions?
Yeah. So second thing Amitabh is on the deal you said ends in March.
So sorry to interrupt, but your voice is a bit muffled, sir. If you can change the mode of connection, please.
Sorry, let me try this first. I'll come back.
Others are struggling to hear you. We are really struggling to hear you.
So maybe request you to rejoin the queue, please, by changing it.
Sure, I'll do that then.
Thank you.
Thanks, Adarsh.
Before we take the next question, a reminder to the participants, please limit your questions to 2 per participant. For any follow-up, may we request you to rejoin the queue. The next question is from the line of Kunal Shah from ICICI Securities. Please go ahead.
Yeah, congratulations, Amitabh, Puneet, and the entire team. Firstly, now, as you highlighted in terms of, say, deal coming closer to an end, and maybe you highlighted in terms of the growth opportunities which are there, and it's visible across the broad-based growth that we had seen it in this quarter. So what would be the capital raising plans, and when can we, are we looking at something in the near term? So that's the first question, yeah.
So maybe I think Adarsh was trying to ask the same question, maybe using Citi's acquisition as a base. So Adarsh, if that was the question, I'll try to answer in detail. First, I'll make a couple of points here. One, if you look at our consumption of capital in the first 6 months of this year, our profitability has ensured that the consumption of capital is minimal. So we are at 15.14%. Post the Citi acquisition, which we are saying will happen in the first quarter of the next calendar year, or if it gets delayed a little bit, maybe in the second quarter of the next calendar year, we will consume 177 basis points of capital. The benchmarks we have set up internally give us enough cushion to ensure that we are not under any pressure whatsoever to raise capital even post the acquisition. We want to be sure, we want to bide our time, we want to be sure about the price at which we raise capital if we want to raise it, because we want to ensure that the minority shareholders, the shareholders which are already there, do not get diluted too much. So today, as we stand today, we have absolutely no intention, as we stand today, to raise capital at least till the Citi acquisition is done. Even post that, we will, obviously continue to evaluate various alternatives, including whether we need to raise capital at all or not, and then decide the right strategy depending on, how we are doing, what consumption of our capital is for our running business at that point in time, how the market is, what the price is, and whether that timing would be right at that point in time or sometime later in the future. So I'm giving you 2 answers. One is that we definitely don't see us raising capital up to a certain point in time, and beyond that also, we will let you know once we reach any conclusion in terms of timing, if any, at that point in time. Does that answer your question?
Yeah, that answers the question. And secondly, when we look at it in terms of deposits, I think the action has been more on the wholesale deposit rates compared to that of retail for us. And I think this repricing, given that MCLR and EBLR linked is higher, now there will be further repricing which is going to happen out there. And we have seen this kind of improvement in the spread. So do we see raising the retail deposit rates and trying to garner more of retail deposits in the second half?
So,
action is absolutely right. Relatively slower for us compared to other players, yeah.
So, we have obviously, I shared with, when I was asked a question earlier, some of the data points in terms of how our overall deposits have done. We are trying to solve many problems. We are obviously trying to solve for a franchise, issue in terms of how we are working and how the rigor and the rhythm is working within the overall retail franchise to ensure that we can grow the deposits at a certain rate. We are working to ensure that the share of premium deposit increases. We are trying to ensure that the outflow or the weighted average outflow is brought down. We are also trying to ensure the shift between, the RTD and NRTD. We are also at the same time trying to expand our franchise. We are also trying at the same time, there are a number of things which we are doing. The reason I'm telling you all this is, and this means that as the liquidity is sucked out of the system and as market evolves, we will be strategic and tactical at the same time. Now, will it include trying to raise retail term deposits to garner more deposits? I mean, it could. What we have seen in the past, increasing term deposit rates by a small amount does not have a real impact in terms of ability to raise more deposits. That ability to raise more deposits quickly is more on the wholesale side than on the retail side. Retail side is more, daily tackling and pushing with the customers. The 5, 10, 15 basis point increase does not really make a huge impact. That's what our experience is. So rather than saying this is exactly what we'll do, I've given you a sense for what are some of the things which we are working on. We also, by the way, we promised to you that we'll work on them. We have been working on it, and now we need to ensure that we keep it in the same zone. So, given all those factors at play, if some tactical move will help us in pushing the growth rate of the overall deposits, we will definitely look at it. Are we doing something of this nature at this point in time? No, but we obviously keep all our options open.
Sure. And lastly, maybe during the call, if you can just share with respect to the Max Life and maybe the IRDA's and maybe order which was there, if you can just share in terms of how the dynamics or maybe the acquisition could get impacted. So that would be great if you can make some comments outside of whatever has been filed with the
Max. Happy to share. Max has applied for various approvals under the agreement which we have entered with them when we became a promoter of Max Life. As part of the evaluation of that particular proposal, IRDA has taken a view on the transactions we have undertaken. We are very clear that the transactions we have undertaken are part of two separate, distinct agreements, and we do believe that our legal position is strong. But at the same time, we want to ensure that we work with the regulator rather than, and so in that spirit, we will evaluate the order which has come and work with the regulator to ensure that we can move forward rather than getting caught up in the transactions we've done in the past. We stay very committed to the partnership as a promoter and bancassurance. We stay very committed to increase our stake to what we had signed up for. I do want to reiterate that we believe all rules and regulations have been followed through the deal process. But I do want to end by saying that our idea is that because we have a pretty decent stake in Max, we intend to stay as a promoter for the longest period of time. We would like to work with the regulator and find the right solution rather than, be at odds with the regulator's thought process. So hopefully that gives you enough insight on the transaction.
Okay. Yeah. Thanks. All the best.
Thank you.
A reminder to the participants, please limit your questions to 2 per participant. The next question is from the line of Jiten Doshi from Enam Asset Management. Please go ahead.
Yeah, many congratulations, Amitabh, on an excellent result. I just want to find out your level of confidence in terms of the sustainability of this performance over the next 3 years as you plan the future cycles.
Jiten, thanks. As I said earlier, that our desire and our intention and whole execution has been around creating a sustainable franchise rather than trying to deliver things quarter on quarter. Yes, over the last 7-8 quarters, there have been some quarters where some metrics have not necessarily been in line with what the market expected. But our intent has always been to deliver consistency and stability and sustainability. So whatever metrics we are achieving, we do hope in the medium term we will continue to maintain or improve them. And I can't comment quarter on quarter, but that's the intent, that's the hope, that's what the entire management team is trying to execute on.
So are you reasonably confident that the foundation that you have built over the last 24 months is strong enough to get you where you want to go?
Well, Jiten, with your support, hopefully we'll get there.
Fantastic. I have no other question, and many thanks and lots of congratulations to the entire team. Very well done. I think you'll have stayed the course with huge conviction. Keep it up. All the best to you.
Thank you so much.
Thank you. The next question is from the line of Abhishek Murarka from HSBC. Please go ahead.
Hi, good evening. My questions have actually been asked, so congratulations for the quarter and all the best. Thanks a lot.
Thank you, Abhishek.
Thanks, Amitabh.
Thank you. The next question is from the line of Mahesh MB from Kotak Securities. Please go ahead.
Hey, hi. Thanks. 2 questions on my side. One is the lack of growth in retail deposits, which seems to be an issue for the industry as a whole. Is there any reasons that you could attribute to that? Is there are retail saving less, slowing down? What would you assume would be a possible reason for this?
So Mahesh, you are right that ultimately, the liquidity has been sucked out of the system and it does have an impact on overall deposit growth. The numbers are quite visible. The credit growth is right now faster than the deposit growth. So there is a scramble for deposits. But immediately in the same breath, I would say that our market share in deposits is 4.7%. Yes, obviously we have to be worried about the macro and what is going on. We are very clear that there is a positive for us if we get our act right, if we get this, this whole deposit franchise the way we want it to work, that, even if the industry growth is impacted, we can and we should aim for, continuing to push our deposit growth upwards. So let me just stop there. I'll ask Ravi is here if he wants to add anything.
No. Sorry, Amitabh, I just kind of probably just add to this. So the question you're asking is that on one side, retail loan seems to be quite good, but retail deposit doesn't seem to be going that well. How would you explain the dynamics that is working between both sides of the balance sheet for you and for the system as a whole? Sorry.
Yeah. So thanks for that question. I think as Amitabh said, this divergence is being seen after some time. The consumption pattern has gone up substantially in terms of how the individual households as well as small businesses are working through. And therefore, in terms of the outflows that we are seeing as an industry, that is the fundamental shift that has happened. Whether you call it, as you can see, credit card spends going up, you can see consumption spending going up, you can see the cost of EMIs going up, and therefore that's the fundamental shift that has happened, disruptively in the deposit space.
And that you're assuming is flowing back into the system through corporate profits or in terms of higher corporate or wholesale deposits?
So, Mahesh, we are continuing to work on building blocks, and it's not just about the retail deposits. The same thing applies on the wholesale side also. I talked a lot about what we're trying to do on the transaction side of the business. I also talked a lot about how, even on the digital side, we are trying to create customer journeys where customers can actually just come into us. So, we are very focused on continuing to work on building blocks which will allow us to grow at a different pace in the medium to long term. We realize that there is a problem in the system in the short term, but the message which you're trying to give internally is our market share is where it is. We can definitely, for us to grow at a certain rate, it is not very difficult, should not be very difficult, but yes, the whole culture, the rhythm, rigor and all is a work in process, and we are confident that with all the measures that we are taking over a period of time, we should be able to get there.
Perfect. Thanks for this. Second question is, one of the challenges that most of us have on this side of the market is that the disconnect that the banks in general are so confident about growth and asset quality, and there is slowdown that seems to be there on the other side, whereas we are not able to kind of connect the dots and come to a conclusion. How would you kind of respond on this question?
No, Mahesh, you're asking a great question that given what is happening on the macro globally, even in India to some extent, is there a possibility that the risk or the overall underwriting standards could be diluted, or overall asset quality could deteriorate over a period of time? We are watching some of these numbers very, very closely. I think Axis has moved the needle in terms of the asset quality it has created over the last 3-4 years. If you look at all our matrices, if you look at our 90 DPD, we believe we are best in class when we compare to some of the best franchises out there. And we are not diluting our risk framework. We are watching our risk framework very, very closely. If required, I'll ask Amit also to kind of add any comments which he has. But it's something which I can only say this, we are watching that any deterioration of any kind very, very closely, because you're making a very good point that if the world is going to go through what it seems to be going through, there are chances tomorrow that things could, slip a little bit here in India, and we don't want to get caught up in that scenario in any circumstances. Amit, you want to add?
No, I think, Amitabh, you've added. Just one point is that the risk frameworks that we've built we've put in place thresholds for which we actually take risk action quite instantaneously. So at the first signs of trouble for any of the segments that we operate, or locations, or a profile, there will be immediate risk actions that we will take, and those are frameworks that we've kind of built right to the last 2 to 3 years, especially post-COVID.
Mahesh, the other thing that, if there are discontinuities in the sort of global economies as we go forward,
maybe there will be some issues in terms of growth, and that is something that we could potentially worry about as we go forward. But I think one of the things that you should also consider is that corporate balance sheets are in pristine shape. Debt equity is at 0.5, 0.6 times, and so therefore, at least from the wholesale side, there is a great deal of comfort that given the fact that the banking system at large has not done large-scale lending to the corporate sector over the last 3 to 5 years, and corporate balance sheets are in great shape, the probability that you're going to see risk play out very quickly in that space looks unlikely.
That's perfect, Anand. The only worry this time we see almost all of the banks in general, is that the substantial risk that all of you guys are putting on the SME space, where the markers available for us to track seems to be exceptionally low. That's the only worry, but thanks for this.
I think as far as the SME side is concerned, the one thing that you should consider there is the fact that it's a granular business across multiple sectors, across multiple geographies. So one of the things that you're trying to do is to ensure that you are diversifying risk as far as possible, and ensuring that the correlations between sectors is we do track that, and it is relatively low. Second is the collateralization that is available in this sector. So those are the two, I would argue, mitigants to the SME sector. But there, once again, if you look at early delinquency numbers, etc., there doesn't seem to be anything to worry about at this stage.
Absolutely. Thanks a lot, and congratulations for a great result.
Thank you. The next question is from the line of Ajit Kumar from Goldman Sachs. Please go ahead.
Good evening, everyone. Thanks for taking my question. Coming back again on the deposit side, what is driving this high CA growth in this quarter? 13% Q&Q, that is one. And while you have taken multiple steps to improve the liability side, as you have explained, can you guide in terms of timelines when we'll start seeing an inflection in terms of deposit growth picking up, as CD ratio has already reached 90%?
So you heard Amitabh talk about the building blocks in place, and you are beginning to see some of the early wins on the current account side. We're winning significant mandates on cash management. We're winning significant mandates on our government businesses. We are winning significant mandates on the trade finance side as well. And I think and if you look at the market shares on NEFT, RTGS, GST, all those are going up, which really means that thanks to the technology we have now put in place, increasingly customers are using our current account as a current account of choice, and that is helping us build transaction balances and therefore CA balances. And I do believe that this growth here is sustainable.
Okay. So there is no one-off here. It is going to be sustainable going forward as well in current account.
There will always be, it is a current account, so there will always be some lumpiness, and that one-off lumpiness will always be there. It's not as if there's anything unique to this quarter.
Okay. Thank you. Thanks a lot.
Thank you. The next question is from the line of Nitin Agarwal from Motilal Oswal. Please go ahead.
Yeah, hi Amitabh, Puneet and team. Congratulations on great set of numbers. So, first question is around the margin line again. This quarter we have taken a big leap and covered what we indicated in the last quarter, that it will take probably 8 to 10 quarters for us to reach, and now we have beaten that number. So what has really changed? While positive surprises are always welcome, but I was just curious to know as to what has really changed to have driven such a big jump that we didn't really indicated in the last quarter.
Thank you for the question. I think broadly we've spoken about the multiple initiatives that the bank has been taking to create a robust platform across multiple aspects to strengthen NIMs, both on the assets and liability side. The progress on each of those work streams have delivered the current result. I'm happy that it is more positive than the outlook we provided, but it is brass tacks, hardcore banking that has delivered these numbers for the quarters.
I think you should, I just really appreciate, Nitin, that I'll add something there, that, some of the increase in reverse repo rate allowed us an opportunity to, move on some of the fronts faster than what we had anticipated. I think given that the whole system was working towards improving NIMs, our ability to react and move on that, move forward on that basis did help us. But as Puneet very rightly pointed out, it is, the whole system was very clear that we had to get the margin to the zone which we had been promising to you for some time.
Right. And the second question is around the business growth. Now, while you have explained onto the retail deposit part, but knowing that the CD ratio is now hitting close to 90, so do you think it can in a way limit the advances growth for the year, because first half has been relatively soft and we are looking for a pickup in the second half? So can this come in the way of chasing the advances growth in the second half?
So first principle is that we obviously would like to do things whereby the NIM is in the same zone. We would not like to just for the growth sake again go down the path of showing growth and then sacrificing NIM in the process. Now, assuming we can keep our mix intact, we can keep our NIMs intact, we do believe that there are sources of deposit out there which we can raise, which will allow us to manage that growth. Because there are a number of levers which are available to us. Obviously, in the long run, we want to build a franchise where the CASA ratio is higher than where it is. We obviously would like to ensure that the retail TD growth rate picks up. The penetration levels, which are right now lower in comparison to some of the others, does pick up. And obviously, we are working towards it. But in the short term, if there are opportunities which come our way, we do have flexibility to, raise that money for a reasonably long term quite quickly. So we'll, obviously capitalize on those opportunities as they come along.
Sure. Thanks, Amitabh, and wish you all the best.
Thank you.
Thank you. Ladies and gentlemen, due to time constraint, we take the last question from the line of Samir Bise from JM Financial. Please go ahead.
Yeah, hi. Thanks for the opportunity and congrats on a super quarter. Just looking at slide 19, I just wanted to understand the split on the retail SA balances. Could you kind of highlight what would be the approx range of salary balances within this split? And secondly, the 49% number is only Burgundy and Burgundy Private. Is that the right way to look at it?
Thank you for the question. I guess the slide 19 that you're referring to for the benefit of others is the customer pyramid that we publish, and you want to know the balance across the customer pyramid from EZ to Burgundy Private. We do not
be so detailed, but some trajectory on where would what range would the salary share be would be helpful.
So we don't disclose the salary share across the customer pyramid, and therefore that's not a number that we'd like to talk about. And to your second question on premium, I would request you to look at the footnote on the same slide. Premium includes Burgundy Private, Burgundy Priority and Prestige, and our NRI segments, which we've called out specifically with that disclosure.
Okay. Sure, this is helpful. Congrats and all the best. Thank you.
Thank you. I would now like to hand the conference over to Mr. Puneet Sharma for closing comments. Over to you, sir.
Thank you, Stephen. Thank you, ladies and gentlemen, for taking the time to speak with us. It's been a pleasure. If there are any other questions that we have not been able to answer, please feel free to reach out to Abhijit. We'll try and answer them subsequently. Wishing you and your families a very happy Diwali and all the best for the season. Thank you and good night.
Thank you. Ladies and gentlemen, on behalf of Axis Bank, thank you for joining us, and you may now disconnect your lines. Thank you.